Welcome back. The SGX Nifty is indicating that we'll have a positive start, 67 points higher. And this is because global markets are looking slightly better, especially the US futures, which is where most of the cues are now coming from. And that's looking slightly better. So most of the markets have seen a bit of a bounce. The US, remember, yesterday on the S&P 500 went very close to the 52-week intraday low, the June low, and sort of managed to save that by about 8 points. Prakash Diwan is with us. Prakash, good morning. Thanks for joining us. Prakash, let's start with some of these stocks where now we are beginning to see some big, unwinding. The Adani Group stocks, cement stocks, Ambuja ACC. Do you think there's more left here, or would this be a buying opportunity?
Good morning, Anuj. So, I think it's not surprising. The risk off that we are seeing prevail in the market and deepen with every passing day would kind of, see some sort of sell-offs in these overvalued counters and sectors. So there are pockets of exuberance which will see a little bit of rationalization and then consolidation thereafter. But if you ask me fundamentally, they're still not within that value zone of sorts from a valuation perspective at all. You'd have to wait for some more easing off on those prices to kind of see that happen. And selectively, it'll be businesses that will not get impacted, which are far more insulated. So, namely, you would have the ports business that would probably continue growing, given its inorganic growth as well. From the cement pack, I think this whole thing of the M&A wave that we were kind of expecting to be unleashed immediately might not happen so soon. People will focus on their organic capacity expansion more than just inorganic growth at the moment. So all that conjecture will probably start getting into a bit of rational rub-off. And from that perspective, I think, I'm not saying Ambuja or ACC might not continue to do well, but the rally might not be as spectacular as what we've seen in the last 1 month or so. So it'll probably grow inch up gradually. So you could add it into a portfolio if you have a 3-year horizon, but otherwise, wait for most of these stocks to, a lot of these pockets to kind of ease off. And there are new pockets emerging, there are new sectors, themes emerging, which still offer a little bit of reasonable risk reward. So that's where people should probably be focused on.
What are your thoughts, Prakash? Good morning. On SBI cards, the data is looking good. The performance in August was better than the industry average. And SBI cards has also gained market share in spends, which is, I think, the first time in the last 5 months. Is this a stock that you like?
So, good morning, Sonia. So, not particularly. I have never been a big fan of this space. And very few listed players there, or to be honest, a pure play credit card game. But, globally what's happening is, and India more so, at a pace that is uniquely frenetic for us, the adaptation of other payment mechanisms is probably going to leave cards, in a spot which is not very high growth anymore, as much as you see globally or in the US. And in that space, this particular change that you see in market share is probably because Citi and Axis, once that merger happens, will see a little bit of a blinking. So once the biggest market leader or one of the biggest players blinks, you'll probably see some market share shifts happen. So it could be SBI, it could be HDFC at some point, ICICI Bank with the cards business. So you'll see all the market share shifts. Because my sense is a lot of the Citibank customers might not have the same, comfort going into the Axis relationship immediately. And they would kind of, not use their cards till they've tried it out and got into that comfort zone. So that transition is vacating some space. But I'm not a big fan of this space, as I said earlier. But SBI cards probably seems to be doing well from what data we see. If people were happy with that kind of a thing, but it might not last too long is my view, Sonia.
Prakash, those who are carrying maybe leveraged positions, because things happen so quickly, both on the downside and upside, right? You get caught on the wrong foot and then you're stuck waiting for a better price to get out. Or, what's your overall sense though? Is this, we may get momentary pullbacks, but overall there will be a little bit of pressure. The bias is on the downside. So what should one do?
So good morning, Prashant. So I think, if you recall about a month back, we kind of started getting a bit cautious in terms of the way valuations were sitting, and India was the only performing market. And performance and outperformance particularly comes with a heightened level of risk. And that's exactly what we are seeing play out in the market. But one good thing about this overall texture from the global cues that we are attuned to, and there's nothing domestic that's moving our markets at this point. To be honest, we'll have to wait for earnings season to kind of start flagging of some moves. For people who are stuck with stocks where they're seeing erosion happen so rapidly, I think you need to be patient if fundamentally the stock picking selection and the portfolio construct is positive. Unless it was a trading punt which didn't work out, and you would have to get your stop losses triggered. But from a investment perspective, I think the time to invest is great at this point. October is probably one of the best months in hindsight. We thought June was that, but probably you missed out, and October is giving you those opportunities. The risk assessment globally, if you see, everybody's talking about a recession, everybody's talking about tough times, and when that happens, the actual risk is much less. The perceived risk is too high at this moment, and I think that will translate into a lower level of actual risk in the markets, and that's where value investors will probably benefit. So who have the courage and a view which is slightly more long term.
Okay, well, just stay on. We'll just come back.